Pricing is one of about 8 or 10 things that a savvy small business borrower should want to ask about when applying for an SBA loan, but it's rarely talked about in public, and SBA rates are rarely advertised. You don't see them really on marketing materials. What's the big deal here? Let's peel back the curtain and talk about how you should be pricing your loan. When we talk about pricing on 7A loans, we're talking about the interest rate. 7A lenders charge minimal fees, so interest rates are really how the lender makes their money. And how a lender prices their loans kind of depends on their business model. Large banks, for example, have many products across the board, so earned interest on SBA loans, very tiny in the grand scheme of things to them. They're probably just thinking, let's just stay out of trouble here, and let's try not to lose money on these things. So they're going to price their loans on the lower side of the spectrum, and they'll be very conservative in their underwriting. Then you have banks and non-bank lenders that specifically go to market to make money and to run a profitable, sustainable SBA shop. That's what we're talking about here. And even within this group, there's a wide spectrum of SBA programs out there that range based on their credit appetite, how they structure deals, etc. So the first thing to consider is the term of the loan. Business acquisitions, leasehold improvements, working capital, these are financed over 10 years, whereas real estate can be financed over 25 years. So the value of a 25-year loan is going to be greater, and therefore you should have lower interest rate options on 7A real estate loans. I like to say that pricing is based on the overall risk of the transaction. So essentially, when you're pricing a deal, you need to consider what industry the business is in, how much collateral there is, the experience level of the applicant, and their personal credit score, and also debt service coverage, of course. Now, the SBA does make it somewhat consistent in the sense that they cap the margin you can charge over the prime rate. So the maximum rate is prime plus 2.75%, which today is 6%. And I price just about every 10-year loan that I do at that rate, and that's because most of these 10-year loans are short on collateral and warrant higher pricing. But on the real estate side, there is collateral. So what kind of deals get the best pricing there? Multi-use real estate, that's like a warehouse or an office building where you can run a bunch of different types of businesses out there, and therefore it's easier to liquidate. That's a less risky type of transaction than a special use property like a car wash or a gas station where that property only has one single use. Then you have the industry. Low risk industries are much more sought after and warrant lower pricing because it's more competitive. And that includes your doctors, lawyers, insurance brokers, professionals, things like that. Restaurants, hospitality, fitness, that would be on the other side of the spectrum in today's day and age. And pricing is probably going to be higher on those types of loans. Time in business matters. Startups are very hard to get done in general. So it's very rare that you'd offer anything less than 6% on a startup loan. But if they've been in business a long time, they're buying real estate, and they're in a good industry, now we're starting to get towards the lower end of your pricing structure. By the way, most 7A loans have a variable rate, but fixed rates do exist, mostly on real estate deals, and the lenders that offer them are looking for the best of the best and will likely be less flexible and less aggressive in structure than lenders with higher pricing. Me personally, my borrowers don't come to me for the lowest interest rate. They get a fair rate, but I also understand, and they understand, that I'm delivering something of great value in other areas. I mentioned earlier that there's 8 or 10 things that business owners need to ask when choosing an SBA lender, and pricing is just one of those things. So why would a borrower pay a higher interest rate? Maybe that's the only way to get the deal done because it's a higher credit risk. Maybe the structure is really aggressive. Maybe they're under a very tight deadline and just care about getting it done. Because the one factor that they should be valuing above all else is certainty of closing. SBA lending is hard, and not every lender can pull it off. So I've gotten really good at pricing loans. I kind of just know where the pricing should be on any given deal. Where some of my colleagues get tripped up is basing their pricing on the competition. Even now, you may be listening to this thinking that competition is playing a huge factor in the pricing. It doesn't. it does play a factor in the bank's overall business model. Your business model can't be to try to do A paper deals with B paper pricing and expect to be competitive. But if you competitively price a loan and the applicant tells you that you've got competition, and your instinct is to call your sales manager and try to get the pricing lower to try to win the deal, I would challenge you to give it a second thought. First of all, borrowers have shown me term sheets in the past, and they wanted me to compete on pricing. Every once in a while, I'll see a crazy term sheet from a bank that I'm not familiar with, and I'll just look them up to see how many authorizations they've pulled recently, because that's public data. And if they haven't done many SBA loans, I have no problem telling them that this bank is not very experienced and they've only done X amount of loans, and their best bet is to pick a lender who actually specializes in SBA. But we're not all perfect. If you're competing, dropping the rate by a quarter point wins you the deal, by all means, go for it. Perhaps you priced it too high in the first place and that deal actually warrants that rate. By the way, when you do this, you don't just update your term sheet and send it out. You have to get them to commit. You say something like, if I can get this rate dropped for you by a 0.25%, would you be able to sign my term sheet today? And if they say anything other than yes, absolutely, then they're probably not your customer. There's probably some other issue, or they're not serious, or it's just not a good fit. But what I don't want you to do is just drop the pricing lower than what the deal actually warrants. Even if competition is driving you to do that, if you find yourself in that scenario where you need to drop the rate so low that you don't even think that deal warrants that pricing to win it, I would guarantee that there is something else that you're doing that you should be shining a light on that your competition with the lower pricing is probably not. You know, it's very rare for two lenders to have all the same terms, same process, same everything. No, everyone varies. So you got to ask questions like, how much working capital are they offering? How much equity injection are they requiring? Are they asking for additional guarantees? That other lender might be requiring a corporate guarantee that you are not. And that might be more important to this borrower than a 0.5% difference in rate. Dig deeper, because being competitive is not all about pricing. You need to be competitive overall. And numbers don't lie. There's a reason folks gravitate towards certain lenders and why they avoid others. There's no getting around this. All in all, we want business owners to get a fair price. In fact, I want them to get the lowest possible price as long as all their other needs are being met. I don't want them to overpay, but as a lender, I don't want you selling yourself short either. If you're putting in 110% into your deals and providing that concierge level service, that warrants a premium. You can charge money for that. Not everyone is doing that. That's a premium service and it warrants premium pricing, especially in today's market where capacity is the single biggest issue. Everyone in the SBA world is busier than ever, and business owners really value execution, and a lot of them are willing to pay a higher price for better, faster experiences. So take that and do what you wish. Appreciate you stopping by. We'll see you next time.